Welcome to the Private Lender Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Checking out the show. Welcome to the Private Lenders Podcast. Chris and Jason here, as always. Today we're going to be talking about market updates, what we've been seeing going into the second quarter of 2023. Before we get started, one quick announcement that we are having our Inner Circle meeting here in Maryland at the beginning of May, and it's all sold out now. We're on wait list. The next one will be, we do 2 a year, so the next one will be in November, most likely. If interested, check out Hard Money Mastermind innercircle.com to learn more. Okay, so we came into this year with a lot of uncertainty in the market, right? Like the short-term rates were going up, the long-term mortgage rates were going up back then, 3-4 months ago. And the housing market, we noticed around the end of 22, beginning of 23, was pretty slow. It was pretty slow. There are not that many transactions going on. I remember we were talking around the holidays about the loan payoffs that came in during December, and they were about half of normal, right? So we're like, shoot, things are slowing down a little bit. Transactions aren't moving quite as quick. And that continued for a while. Not really the case now. So let's dive into that.
Yeah, we were just talking to full times a day. Payoffs are coming in. And, you know, the funny thing about getting paid off on loans, it's a love-hate, right? Like it's good to get paid off on loans because you're cycling the funds through. You know that there's capital out there in order to pay the loans off. You know, the market's good because your borrowers are able to sell or refinance. But at the same time, like you don't want to get paid off because the goal of this is to create a large outstanding portfolio. And, you know, you make a lot of money on your servicing fees. And, you know, so that's kind of the love-hate. But it is good that loans are paying off, because like what Chris started with was, it was a little bit scary late into last year, earlier into this year. You know, we were still doing loans, but you know, typically we're used to every day closing a new loan, every day getting paid off on an existing loan, and the loans just weren't paying off as fast as they're getting closed. So, you know, we were nervous, wanted to adjust our underwriting and try to be a little bit more cautious and things like that. But that's not the case anymore. Lots of loans are paying off, because here's the thing with private lending. Ideally, you know, you write a good loan to a good borrower that perform, but, you know, God forbid something goes bad and the borrower is not who they thought they were, or there's something else involved. You know, in a good real estate market, the market can save you. And that's what's happened to a lot of bad loans that hard money and private lenders have been writing over the last decade, including the institutional back lenders, right? Like the markets have continued to go up. So the deals have just gotten better and better and better and better, on your books, because, you know, you write a loan at a $200,000 after repair value, and next thing you know, they sell the property or it's worth $250, right? Just because the market's appreciated. So that's not always going to be like that. And I would caution anyone who is writing 10%, 100% financing loans or 10% down loans, you know, make sure the borrower is bringing as much money to the table, you know, no higher than a 65% LTV. So no less than 35% equity cushion, but more importantly, also make sure they have as much skin in the game as possible. A lot of the stuff that we're seeing right now is obviously, you know, the fix and flip stuff. There's not a lot of capital out there for fix and flip stuff, just so you know. You're not going to have a lot of competition besides maybe other localized private capital lenders, which is never really all that much competition anyways. The competition is when there was institutional back capital out there that was significantly cheaper and significantly more leverage than you might have been. That was competition. That made it challenging to do stuff, but that's not really there anymore. And Chris and I were talking about that this morning, that the only marketing we see from these institutional back lenders is rental 30 product, lower rates on rental 30 product. Let them have that. There's a demand and a need for that, but that's not the types of deals that we're all doing or we're all chasing. You know, we're all chasing fix and flip deals. We're all trying to do, you know, bridge loans on rental properties or small commercial properties. So that's kind of a good thing, that there's not as much competition for you in the fix and flip space. And although there's something to be said about the market being a little bit scary, that there's just less deals. And I think folks are concerned that because there's less deals, there might be less homeowners behind those deals that can purchase these flips. As of lately, I think we're in a good spot. I think I think these flippers are still maybe not getting above market value, but I still think they're getting good market value for a good flip.
Yeah, I mean, things aren't quite as creative now in terms of the deals we're doing as they were at the beginning of the year. And not that we mind that. Like we like creative deals because we know that we can win them, and a lot of other lenders won't know how to do them or won't be able to do them because of their financing. But that being said, I mean, we were definitely having that conversation with our team on our Monday morning calls, like throughout the winter. And then more recently, there's a lot of fix and flip deals in the pipeline, like more so than before, like regular, median housing price, single family home, fix and flip, like bread and butter for the hard money world, right? So there's more of that going on now. And yeah, talking about the residential sales that we've been discussing, keeping our eye on, there still is a lack of inventory. That's been the thing for the past few years. Lack of inventory is causing those properties to move quickly. And that's what we've been seeing recently. Like here in our local area, if you have a subdivision and a few houses come on the market, they've all been selling. And not that there's tons on the market, nor do we really want that. We don't want 15 or 20 houses in one subdivision on the market, then they'll start coming down. But the ones that do hit the market are selling, and selling rather quickly. And that's something different now than 3 or 4 months ago too. I saw some places that were sitting that we know a year ago would have sold really quickly, especially with those mortgage rates and everything else. But yeah, I mean, it's tough. How do you think the rest of this year is going to go? Like it's tough to say.
I mean, I'm hoping that these institutional back lenders don't get back into the fix and flip game. I don't really think that's a space that they should be in, or we even really want to be in. I mean, I know it helps real estate investors flipping houses because it's cheaper capital for them and it's higher leverage for them, but there's a lot of risk in that as well. I mean, managing construction projects and you're not local is a challenge. Most fix and flip lenders are only localized. They're localized just because, like most real estate investors who fix and flip properties or buy assets, I'm not talking about larger multifamily and commercial stuff, but smaller assets, rentals and fix and flips, like they're localized because you need to know the market. You need to know the local regulations. Like that's just how it is. So I think we both always thought that the banks and institutions would never play in that space, not the national banks, not local banks, because it's such a localized business model. And we were wrong about that. They were in the space for a long period of time, but I don't think they really liked being in the space. I think they felt that there was a demand and a need for it. But I think as the market's changed and their rates are higher, I think they'll probably stay out of it, or at least at scale, just because like I can't imagine they can make all that much money for the amount of risk that they have. Like think about it like this. You do a rental 30 product, you have whatever, you're making whatever arbitrage you're making on the capital, and you have it's a debt service coverage loan, right? So you have a tenant in there that can afford the monthly payment just based off the debt, just based off the market rent, market tenant that's in there. And it's a product that will be out for a long period of time. And if you pay it off quicker, there's prepayment penalties, so they can capitalize that way. Like there's only so much money a bank or an institutional back lender can make in a 5-month fix and flip.
Right.
And there's a lot of risk. There's a lot of downside.
Yeah. I mean, when you're trying to get to hundreds of millions or billions, even, like it makes way more sense to do longer term loans because they don't pay off. Right. And not only that, like the amount of profit that some of those lenders were getting from fix and flip might not have been, attractive enough for them. In addition, they started to see, they haven't said too much of this publicly, but they started to see some real defaults on those fix and flip loans. How do we know? Because they were coming across our desks to try and do some kind of bailout, like where the leverage they were doing was too high. And they, it's a big construction job, a borrower that's probably strong enough, but still these projects are difficult. And it was in arrears, and it had been for like a year, and they got to figure out the way out, but they have to figure a way out. But the amount you can lend them safely is much less than their outstanding balance because the initial loan was too high leverage. That's what we have said since we saw that money come into our niche since the beginning, is that they're lending way too high on these properties because they don't know the area or they don't know proper, underwriting for this thing. And so behind the scenes, you just know that they were starting to take some hits and figure out, they got loss mitigation and stuff going on. And these people were stuck. The borrowers are stuck in the loan. The lender's stuck, can't get out. That's got to be on their radar too, for sure.
Yeah, no doubt. Like, it hasn't become public that there is a lot of defaults behind the scenes that are going on these fix and flip loans. And in your area, if you can scrape or just analyze your land records and where they record mortgage and deeds of trust and things like that, go look. And anything that's like has, look for trustee sales, look for assignments, look for anything besides recorded mortgages. And you can kind of, if you want to go down that rabbit hole for hours and hours, you can track to see who's making those loans and who's being paid off and who's in foreclosure. But I've had a lot of questions in the mastermind group related to, will we do bailout loans or recommend somebody doing a bailout loan? And I think the answer is absolutely, if you figure out exactly how you want to structure it responsibly. Like, if somebody owes an institutional backed lender $200,000, like, you can't give them $200,000. Like 100%, they're going to have to bring cash to the table. There's really no way for it to work unless they bring cash to the table, because institutional lenders are always going to lend higher leverage than we all want to lend, right? So I'll give you, I'm trying to think of a few examples of some deals that we did recently. There was one that they owed patch of land or one of those crowdfunding lenders like 210, and we offered him 150 and he took it. He brought $60,000 plus closing to the table. Like, you don't have to feel ashamed providing a number that you're comfortable with. Now, if somebody had a regular construction project and they really just crapped the bed on the deal because they couldn't execute, even if it's at a low LTV, like, you want to be cautious of that. But like in some of the jurisdictions that we lend in, like in Washington, D.C., like it could take a year to get a permit. Right. So some of these deals, like, they haven't even started construction and their loans are called already. And yeah, it might have been irresponsible that they thought they could get it done that quick. But, if you can structure the deal to your liking and it's safe and you think that the borrower is going to be able to perform, that's fine. I would definitely like put a little checkbox next to your underwriting that says, hey, they didn't perform once with this with this lender. So I want to, have a little bit more reduced coverage and lower your exposure. But it's something an underwriting should do. Also, in a market like today, and we've talked about this a lot, like, there's a lack of commercial capital available. There's a lack of all kinds of capital. So being able to lend your own money or to know how to raise capital responsibly to lend out, you have a humongous upper hand, right? And there's, you'll be able to get plenty of deal flow that works. But the small balance commercial stuff, there's always been a niche in the market to do so. And, we've done a lot of small balance. Like, over the last few years, we've continued to do small balance commercial stuff as we've perfected it and learned how to underwrite some of those things, because it's unique, right? Not all commercial assets are the same. You got to understand how to underwrite each one individually. So you got to be cautious on that, but there's always a demand for that. And we're daily looking at opportunities, and we obviously want to be cautious, right? Like, if there's one downfall of a commercial building compared to a residential building, is there's no like 30-day liquidation sale like a residential property, right? If any residential property, in a subdivision or a good area of a city or something like that, like, there's a price that if you immediately list it at, you'll sell it within a week. There just is. It might be 50%, but whatever it is, like, it's very, very, very easy. There's always a handful of buyers, or more than a handful of buyers, that want that. On a commercial asset, a lot of those things could be unique. So you might have a very limited borrower or limited buyer on an asset like that. So that's something to be taken into consideration. But we've been doing a lot of deals. And real quick before we wrap up, and maybe we'll go into more depth into this particular deal in the future, but I'll share a real quick deal that pretty much have been working on all day. It's a term sheet that we're putting out that the borrower verbally agreed. And we don't typically spend all day doing anything, and definitely don't spend all day doing term sheets. But it was a unique one, and it's a $1.5 million asset. and we creatively structured it. In essence, the borrower is paying 1.75 for the property. It's like a medical office that they're going to operate out of. We're giving them a loan of 1.5, and we're cross collateralizing 6 other free and clear properties. Rental property they paid $600 cash for. Rental property they paid $300 cash for. Another rental property they paid $300 cash for. Another rental property they paid like $250 for, and another commercial medical office they paid $800 for. And you might be like, well, why are they tying up all of this collateral? And like they want to, and keep in mind they're still bringing like $350 to the table plus tying up all these assets, and their credit's marginal. It's in the mid 6s, and there's an argument if they haven't owned all this business for all that long as well, but that's the way we're comfortable doing it, right? It's going to end up being like around a 40 LTV or LTC, loan to cost. I guess LTV, it's actually going to be lower than the loan to cost because I think they overpaid for some of these properties. So we're knocking down some of those values. Point being is like, that's the way we wanted to structure this deal to make it work. And it's in, the properties are in multiple counties and owned by different people and things like that. But, we're able to structure it, to protect our interests and our capital investors' interests on the deal. And we can go into more detail if the deal ends up closing. But, again, we verbally go over everything with people first to make sure they fully understand everything and they know what's going on before we spend time to do this. And I mean, this took multiple hours to put this term sheet together because it was, but seems like they want to proceed with it. So we'll go into a little bit more in depth on that. Point of the story is there's a lot of creative deals out there. And if you're creative and if you can figure out a way to kind of make something work, as long as, you have a good operator and you have, most importantly, really strong collateral, could be a winner.
Yeah, I think the takeaway at this point in time in terms of the market and what we're seeing and how we are lending is that things seem to be okay and will likely to continue to be okay. Not like crazy up, not crazy down, which we're totally fine with. And if you're in a position where you control capital and you can do good loans, you don't have to do crazy lending. It doesn't have to be 90 or 100% financing. Like, you don't have to get too aggressive and risky in order to win deals. They are out there. So that should be the takeaway for today. Also, just a reminder, as I started with, if you want to get on the wait list for the Inner Circle, check out Hard Money Mastermind, innercircle.com to learn more. And we'll see you guys here next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.